All right. So as I've told you, I think the hardest chapters are behind us. 10 and 11 are really not too bad. And then 12 and 13, I think, are even easier. So here, what we're talking about is how companies make short-term decisions. What are some of the different types of analyses that we can do as managerial accountants to help managers make short-term decisions? So one important aspect in this chapter is deciding what information is relevant, because there's so much information out there, right? Pretty much any information you want, you could find. Thanks to the internet, thanks to AI, there's just so much information. So how do you decide what information is relevant? Well, there are certain techniques that we will use. And you can apply this in your own life too. If you're trying to make a decision for yourself, like, should I take public transportation or buy a car? Should I stay at home or should I rent my own apartment? Those kind of decisions. Well, there's a lot to consider. There are monetary factors to consider, financial aspects. You can actually quantify into numbers. And then there are non-quantitative aspects, things that you cannot quantify. There are relevant aspects, God bless you, and irrelevant aspects. There are sunk costs, as Christina mentioned. We'll learn what these different terms mean and then how we can apply them in decision making. One example of a short-term decision would be if you run a company and a customer comes to you wanting a special order, something you don't normally do. Should you take that special order or not? How would you decide that? Well, you'd have to look at how much revenue you would earn, what the cost would be. Do you have enough capacity to take the order? And then other non-quantitative factors like, do we even want this customer? What are the employees going to think about this special order? So we'll look at how to make those decisions. There might be decisions about, do we make a component on our own, or do we buy it from a supplier? Think about a product like an airplane that has thousands of parts, thousands of different parts that come from suppliers all over the world. So airplane manufacturers have figured out if they tried to make all those parts themselves, that would be too hard. They have to be experts in all of these different parts. So instead, they outsource it. They hire different companies to make most of these parts, and the airplane companies put them together. Following the news with Boeing, they have not been putting these parts together very well, right? There are doors or door plugs falling off, tires falling off, all kinds of things like that. But still, the way it's worked in the past is you get the suppliers to make the parts to your specification, you put them together, you can call it your product, even though much of it was created by other companies. So how do you decide if you should make those parts on your own or buy them from another company? What if you've got a product that is not performing that well? Do you axe that product and get rid of it? Or might it be worthwhile to keep it? It sounds like a simple question, but you'll see that some cases, especially when you factor in fixed costs, it's not necessarily that simple. It might even be a whole segment of your business, a whole product line or a whole division that is not performing well. But that doesn't always mean that you should get rid of it. So we'll look at how to make those decisions. There are cases where you can take a product and sell it as it is, or you can make it better and sell it for more money. How do you make that decision? And there are situations where you have limited resources. So let's say you've got multiple products that you can make, but you have only so much time, only so much equipment, only so many employees. How do you decide which of those products focus on, which are going to be the most popular? So those are the sorts of short-term decisions that we're talking about this week. This slide compares short-term with long-term decisions. So for businesses, here's some of the decisions we were just looking at. Should we accept a special order from a customer? What is the best mix of products? How much of this product should we make versus how much of that product? Should we outsource or make things ourselves? And then should we process a product further or sell it as it is, right? So that's what I was just telling you. Companies also have to make long-term decisions. That's not the focus of this chapter, but let's look at what some of those might be. Should we buy some new equipment or remodel our old equipment? It's kind of like if you've got a car that keeps breaking down. So then you're trying to decide, okay, should I fix this car or should I just give up and get a new car, right? Not an easy decision to make. Deciding which products you should even make. Sometimes companies change their products. They start out making one product, like Apple. They started off, one of their early products was this device you could use to cheat the phone companies. You held it up to the phone and it made certain beeps in order to, allow you to make long distance calls for free. But that wasn't ultimately the product that made them successful. It was the Mac computer, right? Or Airbnb. Their initial product was a breakfast cereal called Obama O's, named after President Obama. Never really took off, and instead they figured out another way to make money, which turned out to be very successful. So those are long-term decisions about which products to make. Should you expand into a new area, a new geographic area, or even a new country? That's a pretty big long-term decision. And should you buy another company? So we're not going to worry about those long-term decisions in this chapter. We'll be focusing on the short term. All right, let's see. Okay, so as I mentioned, here are some concepts that will be useful in making these short-term decisions. And you can apply these concepts in your own life. For example, if there's a cost that you cannot avoid, meaning if you choose option A or option B, you're still going to have that same cost, then it's not really relevant. Let me think of an example. Let's say you're trying to decide if you should live at home or if you should move out on your own. And you've got a student loan. Well, you're still going to have that student loan, whichever you do, right? Because it's not relevant to the decision. So there's no point in factoring that into that decision because it's not relevant and it's not avoidable. If there is something that can be avoidable, like if you stay at home, you don't have to pay rent. Well, that's relevant, right? And that just seems obvious. But sometimes when there's a lot to think about, it becomes overwhelming. And so by breaking down each aspect and thinking, okay, is this relevant or not relevant? Is it a sunk cost? Is it an opportunity cost? It helps us focus in on what's really important. What is a sunk cost? Who can tell me? What does that word mean? Sunk cost. They're inevitable. At that point that there are sunk costs, yes. Before they happen, they're not inevitable, but once they happen, they are. So a sunk cost is once you spend money that you can't get back, you're stuck, right? You're not, like, I'll give you an example. Let's say you buy a used car. This has happened to me. My son needed a car. He was going to UCSC, and my wife and I were still living in Southern California, so he didn't have any transportation. And for some reason, my wife, usually she does not get involved. She doesn't like to deal with financial decisions. It's not that I don't let her, it's she just doesn't want to. And so she puts all that responsibility on me. Okay? So, but for some reason, she decided that for this purchase of a car for our son, the limit was $4,000. That was the most we could spend. And I looked and I looked, there was nothing worthwhile for $4,000 at that time. I finally found a car that looked like it was in decent shape. It was a Saturn Ion, not the greatest cars, but it looked like it was in decent shape. My son and I went, we test drove it. It was a private party that was selling it. The car drove great, looked great. It seemed like it's worth $4,000. So I paid the guy cash because, again, it was a private party sale. He signed over the title. And then my son had to go back to Santa Cruz. He was going to drive from Orange County back here to Santa Cruz the next day. So, and it was a Saturday. So I said, you know what? I don't know if they're going to be able to look at it, but why don't you take it to my mechanic, because they're open today, and see if they can just check it out before you drive it back. On his way to the mechanic, he calls me and he says, Dad, something's going on. The locks are just going up and down like by themselves as I'm driving. The lights are like flashing. I don't know what's going on. The car's like not really going. Geez, we just test drove this thing just an hour earlier, half an hour earlier, and it was fine. And now it's like freaking out. So we take it in, and it turns out the computer died, which was like a $4,000 repair. So we just paid $4,000 for the car, right? Because that's all my wife would let me spend. And now we're spending another $4,000 on repair. So I had a choice at that time, right? It was a sunk cost. We'd already lost that $4,000. I did call back the guy that told it to me and say, hey, did you know that there was a problem? He said, oh, no, I didn't know. So I don't know if he knew, but it just seemed really weird. Like right after we bought it, just the computer died. He probably knew, and he was probably sweating while we were test driving it, thinking, I hope it doesn't start acting up, right? So anyways, the point is, it was a sunk cost, right? There's no way I could get that money back from that guy. But I had a decision to make. We could just walk away, junk the car, get nothing for it, and go buy a different car. Or, and this is what tends to happen, once you spend money, you feel like you need to get your money's worth, right? So I ended up spending another $4,000 to get a computer fixed, and then, a couple months later, it was something else, and something else. So it turned out to be kind of an expensive car. And it got to a point where it just was no longer worth fixing. But that's what a sunk cost is. And the reason it's really important to identify is because we are emotionally attached to those decisions. So if you, for example, let's say you decide to buy some cryptocurrency, and then it crashes in value, and you've lost your money. So you think, oh, well, now the price is lower, I'm going to buy some more. And that way, when it comes up, I'll make some more money. Maybe, but maybe you're just digging yourself deeper in the hole, right? So we need to try to not be emotionally attached. When there is a sunk cost, realize it's no longer relevant and think, would I invest more money in that crypto today if I hadn't already invested? Would I still buy that car knowing I had to put another $4,000 into it, right? So that's the significance of sunk costs. Any questions or comments? Okay. Then there's opportunity costs. So that is when you've got different choices, and if you choose one choice, you give up some revenue, the opportunity to make some revenue from the other choice. or you give up a cost saving from the other choice. So opportunity costs are just the cost of choosing A over B, whether it's giving up revenue or giving up a cost savings. So by dividing the different types of costs into these categories, it then becomes more clear which ones to focus on. Opportunity costs are relevant. Avoidable costs are relevant. Some costs and unavoidable costs should not even factor them into your decision. Okay. All right. So here's an example. Need to choose between going to graduate school. So you've already gotten a bachelor's degree. Now you need to figure, do I go directly to graduate school? Or taking a job offer of choice, right? They both have pros and cons. It says if you take the job, you're going to get an apartment. I think it says with a friend. If you go to graduate school, you will live at home. Okay. So there's some relevant considerations there, right? Because if you get an apartment with a friend, that's going to cost you money. Living at home, well, it depends. Your parents let you live for free, great. They charge you rent, well then that'll cost you money too. And it says your commute will be the same either way. So that's not relevant. We don't have to factor that in because it's going to be the same either way. And we already bought a new car. Okay, what kind of cost is that? Some cost, right? You might be able to sell the car and get some of that money back, but you know you're going to lose some of the value, right? By doing that. Okay, so rent and tuition. Obviously, if you take the job, you don't have tuition. On the other hand, if you stay in school and live at home, you don't have to pay rent. Okay, so you have to factor what those costs are and compare them. And let's see, gas and insurance, it says, are both going to be the same because you're driving the same distance either way. So that's not relevant. The car payment, not relevant. It's too late. You already bought it. Opportunity costs. So if you work for 2 years, that's income, right? If you stay in school, you're giving up that income. So that's an opportunity cost. On the other hand, if you take the job, you're giving up that master's degree, which also has value, both monetary value and non-monetary value, right? Just having the degree, not only will it help you make more money in the future, and increase your self-esteem, increase your knowledge, right? Open up new concepts that maybe you didn't know about. So what are we going to consider in making this decision? Which would be the factors we would consider? Would we consider the fact that we already bought a car? No. It's a sunk cost. Would we consider the mileage, insurance, gas? No, because those are going to be the same either way. So what's left? Salary. Salary versus the education, and then rent versus tuition, right? God bless you. Okay. In fact, my daughter is just making that decision. She applied to 3 different master's programs. She got into all 3. Now she's thinking, I don't want to do it. I want to keep working. So that's fine. I kind of wanted her to do the master's, but it's her decision. Okay, so here's a decision. We got a candy company. They bought a new taffy machine for $27,000. Have you seen those? Where they just like keep pulling the taffy? I guess it aerates the candy somehow. All right, so they already bought it, and it'll allow them to produce more taffy. They're trying to decide between hiring 2 part-time college students or 1 full-time employee. Okay. All right, the college students would each work a half a day, so 20 hours each per week. Combined, it's 40 hours between the 2 of them. Or the 1 full-time employee would work 40 hours a week. So it's the same number of hours, whether they hire the 2 part-timers or the 1 full-timer. The rate of pay is going to be the same, $12 per hour. However, they will not give benefits to the part-timers. If they hire a full-timer, going to give that person benefits that cost $2 per hour. So that's relevant, right? They'll have that cost with a full-timer, they won't have it with the part-timers. Also, each employee gets 2 t-shirts to wear as their uniform, fancy uniform, a t-shirt. And they get 2. So that means if they hire 2 employees, that's going to require 4 t-shirts. If they hire 1 employee, that will require 2 t-shirts, right? Also, they use 6 gloves per 8-hour shift, or 4 sets of gloves per 4-hour shift, and 1 hair covering per shift. So there's going to be a difference in cost, again, depending on whether they use the 2 part-timers or the 1 full-timer. Okay, so then we see the cost. The hair coverings are 5 cents per pair. Gloves are 2 cents per pair. Which of these costs are relevant? Are there any relevant revenues? Actually, there was nothing here about revenue, right? It was all about costs. If they said that they're going to sell more product, if they choose option A, well, then that's a difference in revenue, but there was nothing about that. So there are no relevant revenues. Is there a sunk cost in this situation? What is the sunk cost in this situation? The $27,000 taffy machine, exactly. So that's not relevant, right? Because they already bought it. And then are there any opportunity costs? So really what it comes down to here is the benefits, the amount of gloves, and the amount of t-shirts. And we could actually, we don't have to do it, but we could quantify what would be the difference in cost if there were 2 part-timers versus the 1 full-timer. But that would only be financial. Let's think about the non-financial considerations. If you're trying to make this decision, 1 full-timer or 2 part-timers, not considering the financial considerations at all, which is better? 2 part-timers? Well, why?
Contribute more to the workforce.
Can you elaborate on that one?
Or maybe you have more production, you got 2 people working rather than just one. You just have 1 worker.
Mm-hmm.
Maybe he gets caught up behind or something like that.
Okay.
Doesn't have any backup. There's
Okay.
2 workers.
Okay.
Be able to control that.
So you have a little bit more flexibility, maybe with scheduling, maybe if their schedules overlap, they could help each other out. Okay.
Yeah. There's less employment. And then since you get talk about work, the part-timers can work for more, but you charge overtime cost.
That's true. Your part-timers could work extra and it's not overtime, as long as it's less than 8 hours in a day. Whereas if the full-timer works extra, since they already work 40 hours a week, it's automatically overtime. Good point. Are there any advantages though to having 1 full-timer instead of 2 part-timers?
Not having to use like fix the schedule so they're both not working at the same time.
Okay.
They have to be separate to have them work specific days and know their salary.
Okay, so only having to do one schedule. Yeah, okay.
And then having to worry about just one employee rather than just two.
Okay, yeah, I mean, it's less training because you only have to train one person. You only have to oversee one person. On the other hand, if that person's out sick, you don't have any staff, right? So there are pros and cons both ways. There are financial pros and cons and non-financial. All right, any questions or comments? Okay, so special orders. If a customer comes to you wanting you to do a special order, these are some things you would think about. Now, the special order would mean they want some product or service either at a different price, a lower price than you normally charge, or with some extra, costs involved that you wouldn't normally do. So you have to think, first of all, do we have the capacity? If we're already as busy as we can handle, then no, we don't want your special order. Sorry, but we're just too busy. Also think about what would be the cost involved. Since it's a special order, it might have higher costs than normal. Are we going to factor in our fixed costs? Right? Because we're not depending on this special order. It's something extra. So should we apply some of our fixed costs to that order, which reduces our fixed costs for the other orders? Or do we just treat this separately? And then, there's no right or wrong answer to that, but it is something to think about. So in fact, that's probably the one tricky part of this chapter, because every chapter has a tricky part, right? You figured that out by now. Is that some of the fixed costs go away in some cases, and some of them don't. So we have different types of fixed costs. Sometimes you have to factor them in, sometimes you don't. Qualitative factors, qualitative means non-quantitative. So things that are not financial in nature would be qualitative. And there are some laws about pricing. For example, this Robinson-Patman Act has to do with the prices charged to retailers by manufacturers. So probably wouldn't be too common that that would come up, but there are some laws that relate to pricing. So those would be some things to think about before making that decision of should we or should we not accept this order. So here's an example. Our company currently can produce 5,000 chairs a year. And we're producing 4,000. So we've got the capacity to handle another 1,000, right? If we want to. Our chairs retail for $2,800. Those are pretty expensive chairs, yeah. And this customer comes along and says they want to buy 800 chairs from us, but it's a special order. It's not our normal chairs. And they only want to pay $1,800 each. Well, we have the capacity. We can do it. But should we do it? So these are the factors we would consider. If these are the costs for materials, labor, and variable overhead, then it's going to cost us $1,650 per chair that we produce. And the customer is only willing to pay $1,800. So we're making $150 per chair. And we're not going to factor in any fixed costs because we're already covering that with our other production. So basically what it comes down to is we could take this order and make $150 per chair. My guess is we're probably making a lot more than that on our other chairs, right? So yes, this would increase our profit, but is it really worth the effort? You could go either way, right? Depends on how much you want business from that customer and how much you want that extra profit. What if we had to have an extra supervisor just for the special order? Audrey's already saying no, right? It's a no. That's going to cost us 90 grand. Well, is that going to change our calculations here? There's also another $70 of maintenance and utility costs. That's increasing our cost $160,000 for the special order. You divide that by the 800 chairs that we're making, it comes out to an extra $200 of cost per chair. Now we're losing $50 per chair. So I would agree. I think that would definitely be a no. Unless we felt like this was a way to get our foot in the door with this client and they're going to give us so much business in the future at a much better price, right? But if they're being such cheapskates right now, they're probably going to be cheapskates in the future, or maybe they aren't such a great client. But companies will sometimes take a job at a loss, especially if it gets them into a government contract that later they think they can renew, because those could be pretty lucrative. Or you'll see retailers sometimes will have a sale where products are like super, super cheap, but it's just to get you in the store. So they're losing money on that product, but they're trying to get you to buy the other products while you're there, right? So sometimes it does make sense to take a loss, but in this case, we'll say no. All right, so here we have a problem. Let's go ahead and take a look at this one together. Oh, yes. Okay, so problem number 3. Chapter 10. Okay, let's look at the information that's provided to us here. Then figure out how are we going to solve this and decide what we should do. Okay, we are a cupcake company. Our basic cupcake sells for $1.25. So that is the price of the cupcake. And we produced 600,000 cupcakes last year. The costs, here's the revenue. But the costs, we have direct material costs, direct labor, and variable overhead. Those are all relevant because if we produce more cupcakes, we'll have more variable costs, right? However, the fixed costs, in this case, we're just going to say they're not relevant because we have them either way. So we have a special order for 15,000 cupcakes. Customers willing to pay $1.10, which is less than our normal price. And we're going to have an additional $700 in fixed costs because we have to lease a special machine to stamp the cupcakes with the customer's logo. We do have the capacity to do it, so should we do it? So how would we analyze this financially? How do we figure out if it makes sense to do this special order? Well, there are a couple of ways you could do it. You could do it on a per unit basis and try to figure out what would be the cost per unit to make these special cupcakes. And then we already know what the sales price would be because customers willing to pay $1.10. Right? So then we could take the $1.10 sales price minus the whatever per unit cost and see how much profit we'd be making off of each cupcake. The other way we could do it is a total cost. To take the total revenue minus the total cost of this order, and let's do it that way. let's figure out what would be the total cost and the total revenue. How would we do the revenue? How would we figure out the total revenue we would get from this order?
15,000.
Yeah, exactly. 15,000 cupcakes at $1.10 each. Excellent. So 15,000 times $1.10 is $16,500 in revenue. Okay. How would we figure out the variable costs?
You divide it by 600,000 and multiply it by the 50,000.
Okay. So Jordan said we would divide the existing variable costs, which were based on 600,000 cupcakes, right? So it would be direct material, direct labor, and variable overhead. Divide that all by 600,000, so that way we get a cost per cupcake for our variable costs. And then we'll multiply that by the 15,000 cupcakes in the order, and we would know what our variable cost would be. So let's do that. We have 330,000 of material costs, 66,000 of labor, and 84,000 of variable overhead. So a total of $480,000 of variable costs last year. Divided by the 600,000 cupcakes that produced, and we see we have a variable cost per cupcake of 80 cents. Then, like Jordan said, multiply it by the 15,000 cupcakes in this order. That would be $12,000 of variable costs. Okay, any questions on what we did there? We also have the $700 in fixed costs, right? Releasing the special machine. So to get our gross profit, we're going to take our revenue minus the $12,000 of variable costs, minus the $700 of fixed costs, and we end up with a $3,800 profit from this order.
Do not include the fixed manufacturing overhead.
Right. Yeah, we're not going to factor that in.
Okay.
Again, there are some cases where some of the fixed overhead gets factored in, but not in this particular problem. Yeah, it's just the revenue minus the variable and the fixed costs. So let's see, problem 3. Let's make sure I did that right. Yeah, $3,800 is right. Okay, so now we still have to make the decision, right? But at least we've done the financial analysis to decide, is it worth it for us to take this order if we're going to be making 3,800 bucks, right? And then that's a judgment call. But without doing the calculation, we wouldn't even, we wouldn't know what profit we could potentially make. Any questions on that problem? All right, then. So this is next, another special order. Okay, this company's been asked to produce athletic jerseys for a local school district. Special orders for 1,000 jerseys. The price offered by the school district is $10 less than the normal price. Everybody wants a deal, right? What quantitative and qualitative factors should we consider in making the decision? So let's start with quantitative factors. If we had to make this decision, what financial considerations would we have?
other schools aren't gonna order as many jerseys or smaller?
Yes. That would be more qualitative though, right? Unless, are you thinking of some way we could turn that into a financial?
I had read somewhere that it said that, oh, that the school district is interested in the jerseys is one of the largest in the area.
Okay.
I just thought maybe if another school were to ask for the normal market price of $50, they wouldn't order as many jerseys.
Okay, so you could potentially quantify that and you say, okay, if we take this order, what is it going to do to future sales from other schools or future sales from this school? And how could we turn that into a dollar amount? So you could quantify that. That's true. But what would be the immediate quantitative questions we would ask? What financial considerations would we ask ourselves before we made this decision? Okay. What's it going to cost? And how much profit would we make? Right? Now, what qualitative considerations would there be? What non-financial factors would we consider? I'll help you out. So this could be things like, how will our employees react if we take this order? Do we want to work with this customer or not? Do we have the capacity? I'm not sure if it says up here if we have the capacity or not, but that would definitely be a consideration. So those are not financial questions, right? But they're still questions, things that involve preference or psychology, are not necessarily quantifiable in a financial way, but they're relevant. Okay, any questions or comments? Okay, so then deciding whether to make or buy a component. I mentioned airplanes earlier, same thing with vehicles. They have thousands of parts in them. If you think about every screw, every piece of plastic, every piece of metal, software, all, fabric, all the stuff that goes into a vehicle. And typically, the auto companies do the same thing as the airplane companies. They outsource that production, often to companies all over the world. Like most of the airbags come from Japan for some reason. I don't know why. But the company that makes most of the airbags in the world has been having some issues, and there have been so many recalls. Why do we all get our airbags from one company in Japan? I don't know. But if a company like Ford tried to make every part for every vehicle, they couldn't. It would drive their costs up so high, it's a lot more cost effective if they outsource and they don't have to be an expert on every part. I probably mentioned to you, my son works for a car company and they get their parts from suppliers all over the world. In fact, that's a big part of his job, is making sure the parts arrive on time. He was telling me about one part where there's only one supplier in the world that can make this part at a reasonable cost. And that supplier was having some sort of issue, I don't remember what it was, but it was delaying their entire production for my son's company because they couldn't get this one part. And I said, well, can't you 3D print this part or something? But it wasn't possible. Here's an example of a service company, ADP. If you've ever gotten a paycheck from an employer, you might have seen ADP on the paycheck because they are one of the two biggest payroll processing companies. So a lot of companies use ADP to calculate payroll, to actually cut the checks and deposit the funds. So most companies, especially large companies, They don't want to do that themselves. They don't want to be an expert. Can you imagine if you had a company that operated in multiple states and you had to be an expert on all the different employment law that was different in every state and the taxes for your employees that would be different in every state? You'd have to make sure they all get paid properly. Way, way too complicated for most companies. So in other words, as an alternative, you go to a company like AEP, where that's what they specialize in. And you outsource that to them. And they have a really good record, from my experience, of accuracy. So that's what companies always have to decide. Do we do this in-house? Maybe save a little bit of money doing it ourselves. Maybe not. Sometimes it's actually cheaper to outsource. Especially if you end up making a mistake that cost you a lot of money, would have been better to outsource. Or do we outsource? So here's an example of that. All right, so this company makes mugs, a leak-proof personal drink carrier. It seems like those always leak. They're supposed to be leak-proof, but I don't know. They always find a way to leak. And there's a new lid that the company can make on its own, but it could outsource it. If they, let's see, if they produce it themselves, it costs $2.19. However, if they outsource it, their supplier can provide 120,000 lids at a price of $1.75. Well, at first glance, it would seem like, oh, that's cheaper, right? $1.75 is cheaper than $2.19. But you have to think about the fixed costs. Are these fixed costs going to go away, or are we still going to have them? Because if we still have them, then it's not cheaper. So let's take a look here. It says here the only relevant costs are the variable costs because the fixed costs are incurred in either scenario. Okay, so in that case, we're stuck with the fixed costs whether or not we outsource. So they're not relevant, right? So all we have to look at would be the variable costs, which come out to $1.68 for us per lid, which is cheaper than the $1.75 that the other company will charge. So in that case, we should do it ourselves, at least from a financial standpoint. Now, maybe it makes sense to pay the extra money to outsource just so we don't have to worry about the lids. Or maybe this company will make better lids than we could make. Right? So those would be some other considerations. But just looking at the cost, if it's cheaper for us to make it, maybe we should just make it. On the other hand, what if 12 cents out of the fixed costs would be avoidable? Okay, so now we're saying that there are two types of fixed costs. There are fixed costs we're stuck with, and there are other fixed costs that would actually go away if we outsource. And in this scenario, it's saying there would be 12 cents per cup that would go away in fixed costs if we outsource. Well, then if we add that into our cost, now it's costing us $1.80 per lid, costing us more. So maybe we should outsource. Okay, so make sure as you're working on the exercises and problems, pay close attention to when it's talking about the fixed costs and whether or not those are avoidable. If they're not avoidable, they're not relevant. If they are avoidable, then you factor them in to your decision. So then it asks, what are some qualitative factors? Now that we've done the quantitative analysis and we decided it is cheaper, 5 cents per lid, if we outsource, what would be some qualitative factors we would consider? Some non-financial considerations. Point, yeah. Are they gonna be able to deliver when we need it, right? Because if they delay their production or their delivery, that's gonna delay our product. Point. What else? So the quality of the lid, right? If they don't meet our quality standards, that's gonna be a problem. They also said they could only, or at least this bid was to produce 120,000. Maybe we're going to be more than that. Maybe we don't need that many. What if we have a department that's making these lids now and we decide to outsource? What are we gonna do with those workers? We lay them off? We transfer them to other areas? That's an important consideration. And then do we even want to work with the supplier? Maybe they have a bad reputation. Or there's another one. Maybe we're thinking of buying the supplier. We could work with them for a little while, see how they do, get to know their company a little better. And then we decide, yeah, we like the way they operate, then we purchase that company. And then we absorb those extra costs, any extra costs that we had or any extra profit that they're making, we absorb that back into our company. All right, so here's another outsourcing. This is with a law firm, so a service-based company. They're trying to decide if they should hire an attorney to do this special project, or if they should outsource to another company. If they hire an attorney, it's going to cost $120,000 a year, plus $24,000 in benefits, plus that person's going to need a legal assistant. So we get the total cost of hiring that attorney and their assistant. On the other hand, if we hire a law firm to do this work for us, or I guess even an individual attorney, but they're not going to be our employee. We're just going into a contract with them. If they are requiring a $50,000 retainer, which is money we have to pay them regardless of how much work that they do, that's a legal. And we have to pay them a certain amount for every trust that they process and additional fees. I forgot what the additional fees are. Oh, 500 for each trust. Then we see how much it comes to. Now we've already done some remodeling in our offices, so we already have a space. So if we hire somebody, we've already got a place for them to work, but that's no longer relevant, right? If we already spent that money, it's a sunk cost. So we could do this analysis and say, okay, if we hire the person, it's 165,000. We outsource, it's 175,000. However, if we hire that person, once they're done with this project, then what do we do? Fire them, right? Or then we'd have to find other work for them to do. So that would be a consideration. Do we have more control over an employee who's working directly for us or somebody we've contracted with? You have more control over an employee, especially if they're working in your facility. You can see what they're doing, right? Whereas you pay some other lawyer out there, they're working in their own law office. How do you know what's going on over there? So these would be considerations as well. Any other thoughts come to mind in making this decision? Okay, I think, oh yeah, Jahira.
Would the new employee additional training,
Maybe.
or would would they already know what to do off the bat?
Yeah, possibly that they might need some training, but then if you outsource it, you might need to train that person too. That is a consideration. And then you've got this legal assistant too, so then they would probably need some training, you know. And every employee that you have is a liability. This is why companies like Uber and Lyft prefer not to have employees, but to have drivers be independent contractors. Because then the contractor has to carry their own insurance, their own vehicle. If they do something wrong, it's on them. And the employer can say, I'm not their employer. They're my supplier, so it's their problem. Which doesn't always hold up in court, but generally, you know, employees are a liability for a company. Okay, so what are the pros and cons of outsourcing? Now, remember, outsourcing, we often think of as being international, but it can be within the United States. Anytime you pay another company to do part of your business, that's outsourcing. So what are the advantages? Well, if you outsource, that company is probably better at whatever it is that they do than you are. So you get their expertise. It allows you to concentrate on other things that you're good at instead of having to deal with that task. It might free up some money that you're not having to pay for office space and employees because you just pay that company to do it and gives you more flexibility. As I mentioned, allows you to focus on your strengths. Also, you shift some of the risk to the supplier. If you have a contract with them, they're going to sell you a product at a certain price. And then the price of their materials goes up, that's their problem. Because they've already contracted to sell it to you at a certain price. So they're losing profit, but they have to uphold their end of the contract. If you were doing it in-house and your cost of materials goes up, your profits decrease. Right? Disadvantages of outsourcing. Well, you don't have as much control over quality or timing. As Audrey said earlier, are they going to deliver on time? Right? Are they going to produce on time? If you want to be able to upsize or downsize your production, you're dependent on them. Now, oftentimes they can do it really well. I remember back, for example, I used to work at AT&T Wireless in their call center, and we outsourced some of our customer service to another company. So their employees had to be trained to take our calls, so that when we were busy, we could just have them take more calls. And they did that for multiple companies. So it allowed us some flexibility that if we were super busy, we just have them take more calls. If we're not busy, we take all the calls ourselves. But it was really hard for those employees to be good at knowing how to handle our calls and all the other companies that they work for at the same time, right? You tend to lose some quality in that kind of situation. So sometimes when you outsource, it then limits your own ability because let's say we decided we were going to stop using that other company. Now we want to increase our own number of employees. Well, where are we going to put them, right? Do we have the space? Do we have the trainers? Do we have the phone lines? Do we have the computers, right? So if you're used to outsourcing, then trying to bring that back in-house can be difficult. There might be hidden costs. They tell you they're going to do the work for a certain amount. Then you find out there was this clause in their contract that says, hey, if energy prices go up, we're going to have to raise our prices or whatever. And you find you're paying more than you thought. If you're outsourcing, you're not having that experience of doing the work in-house. So you're losing the opportunity to get better at doing it, to innovate and find better ways. You're just throwing money at the problem, not necessarily being more creative. And I already said it's hard to bring the production back in-house. So there's no simple answer here about is it better to outsource or do the work in-house. All right, so here's another option where there's the possibility of an outsource. So the product in question is this axle and wheel assembly that costs $18.75 if they outsource it. The company's own internal costs to produce it are $9 for materials, $6.50 for labor, $3.57 for variable overhead, $2.50 for fixed, and it says 25% of the fixed overhead is avoidable. So what's relevant? The avoidable fixed overhead or the unavoidable fixed overhead? The avoidable is relevant. Unavoidable is irrelevant. Okay? So what we'll have to do, from a quantitative aspect, is figure out what would be the cost for us to produce these assemblies ourselves. How do we do that? What would be the total cost per unit that's relevant? Are the variable costs relevant? Okay, they are. And we know that direct material, direct labor, and variable overhead are all variable, right? So we can add those up. And then we already said that the avoidable fixed costs are relevant. The avoidable fixed costs are 25% of 250, which is what, 62.5 cents, right? So what we would do, in fact, if somebody has a calculator, let's add up 9 plus 650 plus 357 plus 62.5 cents. What does that come out to?
$19.
1969 and a half. Okay, $19.69.5, which is more than if we outsource. So that quantitative analysis was not hard, right? So we save money by outsourcing. Now there are the qualitative considerations, but just looking at it financially, it would make sense to outsource. All right, so as I mentioned earlier, sometimes there's a whole segment of your business. By segment, it could be a particular product line, could be a particular geographic area, could be a certain part of your business that caters to certain customers. And you might find that segment of your business not profitable. So then do you get rid of it? Well, again, you have quantitative and qualitative considerations. But even looking at the quantitative, it's not that simple because you have to think, what is going to be the impact on fixed costs? Maybe this segment is losing money. But if we get rid of it, how much of those fixed costs are we still going to have? And do those fixed costs then just get absorbed by the other segments and cause our other segments to be less profitable? So, okay, so how can we make that decision? We could look at the contribution margins and the fixed costs. That would be one approach. What was the formula for contribution margin? Did it get erased during spring break? qualitative. Sales minus variable costs, right, is your contribution margin. So you could compare the contribution margins of these different segments. Another approach would be looking at the total net income and how that would be impacted by dropping the segment. So it doesn't matter, I mean, both approaches work. So let's see. This is what I was saying was the tricky area in this particular chapter. Common fixed costs. So we've seen this before where sometimes costs are just allocated by the corporate offices to different areas. So basically what the corporate office is saying is, hey, we've got these fixed costs. We think this portion should apply to this segment, this portion should apply to that segment. And you don't necessarily have control over that. And how they allocate it might seem arbitrary in some cases. For example, the CEO's salary. You don't have any control over that. If you're a director or VP or in charge of a segment of the company, you have no control over the CEO's salary, but part of their salary might get allocated as a cost to your area, right? And the logic there is that, hey, the CEO does help the entire company. You might not agree with that, but in theory. Or what about the corporate rent for the corporate offices, and the utility costs for corporate and insurance? All of that might not be relevant specifically to your segment. Yet they might be allocated as part of your fixed costs, right? So then if your segment went away, guess what? Those costs don't go away. They would just have to get reallocated. So that's why it's important when making these decisions to figure out which of the fixed costs are avoidable and which are unavoidable. If they're coming from corporate, they're not going away. They're unavoidable. If they are directly related to your segment or your product line, and they go away, if your segment or product line goes away, then they are avoidable. And so that has to be factored in and making decisions. So here we have an example of this. We've got these three divisions named small, medium, and large. We see the sales in each division. We see their variable costs. We see their fixed costs. If you do the math in your head, it looks like they're all losing money, actually. Not good. But what it says here is that included in these fixed costs are $5.4 million in allocated common costs. So in here, we don't know how much got allocated to each of these three divisions. But in here is $5.4 million of costs that are unavoidable. What's the best way to allocate those costs? Should you divide that 5.4 million in three? You just allocate 1/3 to each division? What do you think? Would that be fair? What would be a more fair way to do it? Okay, you could base it on their sales. You could base it maybe on their profits. Now, I could see arguments for either of those approaches. But yeah, it wouldn't seem fair to divide it evenly in three, because that means for this small division, a bigger portion of their profit is going away to fixed costs. Actually, it doesn't even look like they're even making a profit, right? So yeah, probably something that is based on either the sales revenue or the profits. All right, so here we've got an exercise. Let's do this one. Number 7. All right. So this company makes cereals. And they have an option to outsource 20,000 pounds of production for $22,000. If they make it themselves, it's going to cost them $25,000. However, this manufacturing overhead includes both the variable and fixed overhead. 2,000 of that overhead is variable, and the other 5,000 is fixed costs that will not go away. So maybe they're allocated from corporate, or for whatever reason, they're not going away. So those 5,000 in fixed costs are not relevant, right? If they're unavoidable, they're not relevant. So that means it's really $20,000 for us to make the cereal ourselves, which would be cheaper than outsourcing. So while at first glance, maybe it looked like outsourcing was a good idea, once we factor in that, hey, we're still going to have $5,000 of those fixed costs, then we're better off making it ourselves. So should they make or buy the cereal? They should keep making it. Because 5K in fixed costs will not go away. Does that make sense? Okay. See what's next here. Yeah. All right, well, here we've got these three segments of the business, three different product lines: snow boots, snow sporting equipment, and a clothing line. And we can see for each one, their operating income, and we see for snow boots, it's actually a loss. That doesn't look good, right? In fact, if an investor looked at that, they'd say, hey, what's going on here? That division is losing money. However, we haven't really looked at the fixed costs to consider if we got rid of that division, does that resolve the $76,000 loss? I don't know. It depends what the fixed costs are. In fact, we see we have $392,000 of fixed manufacturing expenses, $216,000 of fixed selling and administrative expenses. And what we don't know is how much of that would go away if we got rid of that product line. So if we rearrange, we take the same information, but we add all the fixed costs in one section over here. So instead of spreading them out across all three product lines, we just group all the fixed costs over here. Now we're only looking at the variable costs. And things now look very different. Snow boots actually are making a profit. Right? You take the sales revenue, subtract the variable costs to get the contribution margin. There is $75,000 of fixed costs that are directly associated with this product line. That is the cost of a supervisor for this particular product line. So because that is directly related, we're going to go ahead and factor that in. But even with those fixed costs, we're coming out profitable. But by that analysis, it does make sense to keep that product line, right? It's adding almost $500,000 a year in profit. And the overall company is profitable, right? It only looked like a problem here because of the amount of fixed selling and administrative and manufacturing costs that were being allocated here, which are not actually specific to this product line. Okay. Questions or comments? Right, whether to sell as is or continue processing. So milk can be turned into various other products, right? Cheese, yogurt, cream, ice cream. They all come from milk, right? So do you sell milk or do you sell those other products? You'd have to take a look at how much additional revenue you could earn by processing them further, but also what would be the additional costs. We will have an exercise like that we'll get to later. But here's one with apples. So this company bought a machine for $450,000 that sorts apples. Pretty expensive machine. And they're trying to decide, now that they can sort their apples, what should they do with their small apples? Should they turn them into apple juice, or should they just bag them and sell them as bags of small apples? So there's a $200,000 cost to lease equipment to make apple juice. So that's something we'd have to consider. Now, if we do a quantitative analysis here, crunching the numbers, if we sell the apples by the dozen, we make $1.10 per dozen apples, right? That's our sales revenue. We see the variable costs involved with selling it. We subtract the variable costs to get our contribution margin. So we're making 80 cents per bag of small apples. If we can sell 200,000 of those bags times the 80-cent contribution margin, that's $160,000 that either goes towards covering fixed costs or is profit. On the other hand, if we make the apple juice, we can sell each gallon for $3.50. There's a 60-cent variable cost. We subtract that, we get our contribution margin of $2.90 per gallon times 100,000 gallons. But we have to subtract the $200,000 apple juice machine we have to lease, right? And so then we make only $90,000. Now that we've crunched the numbers, it looks like we should just sell bags of small apples, right? So that's how you would do an analysis like that. All right, any questions? Okay, another exercise. Oh, is this the ice cream one? Yeah, okay. All right, exercise number 10. So we've got frozen yogurt. We are currently able to sell $8,000 worth of frozen yogurt. If we decide to process it further and turn it into something else, I'm not sure what, it's going to cost us another $2,000. And then we'll make $11,000 instead of $8,000. So would that make sense?
Yes.
It would. We spend $2,000, but we're increasing our sales by $3,000. So yes, that makes sense. So we should make the frozen yogurt. Or I guess we should process it further into something else. Now, what about ice cream? We currently can sell $12,000 worth of ice cream. If we spend an extra $7,000, we can then increase that sales revenue to $18,000. Does that make sense?
No.
Why not? Yeah, we're spending 7,000 to make 6,000. That doesn't make sense, right? So only the frozen yogurt should be processed further. Make sense?
Can you, basically repeat like how you got to that conclusion, like what are you subtracting it from?
Well, if you just think, okay, we're currently selling $12,000 worth of ice cream, right? If we process it further, then we'll be able to sell $18,000 worth. So that's an increase of 6,000, right? From 12,000 to 8,000. But it's going to cost us 7,000 to make that extra 6,000.
Thank you.
All right. Oh, now a problem. Okay, problem number 7. So what we're going to do here is called a differential analysis. We're going to look at the difference between our two options. So it's a little simpler. We don't have to figure out the total cost and total revenue. We're just looking at the difference in revenue and the difference in costs. You guys, can you take the conversation outside? Gentlemen, if you want to talk, just take it outside. Okay, so this company makes some sort of electronic, I don't even know what it is, some sort of product. And they've got 4,600 partially completed models. So they're not complete. There is a recall on a particular part. So now they need to decide, what do we do? Do we sell these incomplete units as they are? Or should we do the extra work so that they comply with the government regulations and then sell them at a higher price? They've already spent $110 per unit. What kind of cost would that be? It's a sunk cost. Very good, because they've already spent it. If they rework each model, it's going to cost them $20 in material per unit and $20 in labor per unit and $7 of variable overhead. There's also $32 of allocated fixed overhead, but that's not relevant because it's not avoidable. So we'll leave that out of the calculation. If they complete these models, so if they do the extra work, they can sell them for $160 per unit. On the other hand, if they sell them as they are, incomplete, then they can sell them for $104. So what's the difference in sales revenue? $56 per unit. Okay, so the differential revenue is $56. And then again, the differential costs are only the variable costs in this case, and they total up to $47. So then it becomes pretty clear. If they do the extra work, they can charge an extra $56 per unit in revenue, but it's going to cost them an extra $47 in variable costs. And so they're really only gaining $9 per unit if they do the extra work. Okay, any question on that one? All right then. Another problem, number 2. God bless you. Okay, this company makes cameras for drones. The basic digital camera uses $80 in variable costs. It requires $1,500 a month in fixed costs. They sell 100 cameras per month. If they process them further, they'll cost an extra 45 per unit in variable costs. And the fixed costs will go up by 1,000 per month. Current price is $160. The question is, if they do the additional work on these cameras, what would be the minimum price they should charge? So to figure that out, let's start with their variable costs for the 100 cameras that they make per month. So it says here that it would be an extra $45 per camera, right? Of variable costs. Times 100 cameras, that would be $4,500. And then here it says the fixed costs would go up by $1,000 a month if they do the extra work. So that's really a total of $5,500 extra dollars per month to do this extra work. And if we divide that by 100 cameras, it's $55 extra cost per camera. Now the current selling price is $160. So now the question is, if they do this extra work, what should be the minimum price they would charge for the camera after the extra work? $215, right? Because anything less than that, now they're losing money, right? They might as well have just sold them as they were. In fact, even at $215, they're not increasing their profits any more than what they are now. So the minimum they would charge would be the differential cost plus the existing price, which gives us $215. All right, any questions on that problem? Okay. All right, so another short-term decision is when your resources are constrained, which they always are. Like if you think of a retail store, they're constrained by square footage. There are only so many shelves that they can put products on, right? Or you're constrained by the number of employees that you have working, or how much equipment you have to produce on. So then how do you decide how best to use those limited resources? So here's an example of this. This company can make 3 different products: desks, chairs, and bookcases. They're constrained by the number of machine hours that they have available, which is 80,000 machine hours. If they wanted to make all the furniture that they could sell, it would take 94,000, which is more than the 80,000 machine hours they have available. So then they have to prioritize, right? They have to think which products are more profitable and would be better to produce. Well, how do you make that decision? You could look at each product, look at the selling price, look at the costs, figure out how much product or how much profit you're getting per product, right? But then you also have to factor in how many machine hours does it take to make the product. So this brings us to what I think might be a new concept for us. I don't know, it might have come up in a previous chapter. Contribution margin per hour. Does that sound familiar? Did we do that before? Yeah. So we see it here. If you take the selling price for each product, subtract the variable costs, you get your contribution margin. But then if you divide that by how many hours it takes to produce it, now you have your contribution margin per hour. So we see the desks have a much higher contribution margin per hour No, actually, the bookcase has the highest, right? Even though the contribution margin is only $48, because you can make 4 bookcases in an hour, you could either multiply 48 by 4 or divide it by a quarter of an hour, which is how long it takes to produce, and it comes out to $192 of contribution margin per hour. Once you've done that with all your products, now you're comparing apples to apples. And it's clear that the bookcases are the most profitable per machine hour. So you want to make as many bookcases as you can, then make as many desks as you can, and then whatever time you have left over, you use it to make chairs. So that's how you would decide which products to make given the limited resources. So if we have 80,000 machine hours available and bookcases are the most profitable, and we think we can sell 40,000 of those, since they take a quarter of an hour each, that's going to take 10,000 machine hours. Now we could make more than 40,000, but if we're not sure that we can sell them, then we better not, right? Because we might end up with product that we can't sell. So once we take out the 10,000 hours that it takes to make those bookcases, we now have 70,000 machine hours left. Well, the desks were the number 2 most profitable product per machine hour, right? So let's make as many desks as we think we can sell. We think we can sell 60,000 of those. They take an hour each. We subtract those machine hours. We have 10,000 machine hours remaining. So we're going to use the rest of those machine hours to make the chairs. And if we can make 2 chairs an hour, or it takes half an hour to make a chair, that means we can produce 20,000 chairs. So that's how we would figure out which products to prioritize given limited resources. Any questions? Emma?
I know that care products, like, so this is only just.
That's a good question. What if the chairs are the best-selling product? Well, we might have some disappointed customers that they didn't get a chair, right? However, they're not our most profitable product. So what's more important? One marketing answer would be raise the price on the chair. There you go. Yeah, bundle them together and say, hey, you buy a desk, you get a chair with it or something like that. Yeah. Yeah, good point. Any other comments or questions? Ooh, looks like it's break time. So see you all in 10 minutes.